people that are in payments often see basis points as their opportunity. In an internet environment, there is no basis point. The margin's already gone. If everybody has access to the protocols and the costs are basically zero, the opportunity ahead of us is what are the value-added services that can be built on top of that. If you're a payments company who doesn't have like a stablecoin strategy, I find it hard to believe that when Visa has many different stablecoin strategies, if your payments company doesn't have a single one, that's a challenge.
Views are personal, not investment advice.
This is Money Code.
It's a show about stablecoins and agentic finance. We're live from Stablecon EMEA. I say EMEA, others say EMEA. Apparently that is a big tension point, but we'll figure that out later. And I'm here today with payments and fintech industry veteran, Ben Milne, founder and CEO of Brale. Great to have you.
Hey, thanks for having me.
And today we're going to talk about two main things. I think, look, we're at a stablecoin conference. We've got to talk about stablecoin issuance. And Ben has been at the center of that for many years. But also, we're going to use the opportunity to look at the future of the banking system. Because with the way that regulation is shifting in the US, there are the seeds being planted and there are undercurrents that are forming that are going to shift how banking and payments will exist in the US over the next 10 years. And I don't think we talk about that just enough. So, without further ado, Ben, can you tell us just a little bit of pre-Brale? Because I think that's important context. What were you doing before, and then what got you to start Brale off?
Well, I've been doing this long enough that apparently now I get introduced as a veteran and someone who's been in payments for a long time. Yeah. But I got into payments because I got pissed off about credit card fees. I ran a manufacturing company that basically we took all of our money in through credit cards and got a little bit obsessed with that particular problem, sold my other company and started working on payments infrastructure. And honestly, what that led to is basically like a bank-to-bank payment network that then got abstracted into APIs. And I think today has become a pretty important part of the US fintech infrastructure. I left that company maybe 5-6 years ago, went for a walk in the woods for a couple of years, trying to figure out if I was going to be retired or not. And, I think there was sort of like a trend where you could see that blockchains or distributed databases were becoming better than relational databases for the job of basically keeping track of transaction data. And once you sort of like think about that, then the sort of like next order of business is, well, what needs to be done in order to fill that space, which is what led to Brale. And we had a thesis or two. I'm not sure what the plural of thesis is when we got started. And thankfully, a lot of those things proved out to be true when the timing was right.
Just for the audience, what does Brale do today?
Brale helps you issue and use stablecoins. You can issue a new stablecoin in about a minute for less than $1. It's instantly interoperable on 30 different chains with no liquidity constraints, and is also interoperable with Paxos, Circle, and now Tether issued assets with no slippage and sitting behind APIs you can actually integrate with.
And so I think a big shift over the last several years has been the ease of which it's been now possible to issue. And so I think maybe call it a couple of years ago, like I was at Paxos, a stablecoin issuer, and at the very, very beginning, you have to stitch everything together from banking implementations to liquidity, to reserves, and to work with a partner to issue a stablecoin would take a lot of time and a lot of money. And now you can do all of that on platforms via APIs through firms like Brale. And so now the question is no longer about how to build all this together to issue. Now issuing is an implementation. It's an API. So what does that shift the question to? If you're a fintech, a company or a business, how should you think about issuing? Or what do you say to the CEOs and the product managers who get on the phone with you?
There's so much to unpack in there. When I first started looking at stablecoin issuance, I did what I always do. I called friends and I said, like, how much, when, how do we do this? And I think the answers were like a couple years, like $100 million. Some wanted line of sight to like $1 billion in AUM. And for most companies, that's just like a non-starter. You can't get over that. So the biggest thing that happens when you bring the cost down to $1 in a minute is it just creates this permissioned environment to go innovate and try new ideas where the risk of failure is like almost nothing. Like, you don't worry about, did you buy a right coffee if the coffee only costs $1, but if you put $100 million into something, you better make sure that's right. Even if you work in a giant multinational organization who has $100 million budgets. So suddenly there's this thing that happens when all of these new companies can try this new idea that before were locked out. Most of it fails, and that's fine. But the stuff that works needs all of the same downline stuff: on-ramp, off-ramps, liquidity, multi-chain capability, wallets, OTC desks, market makers. And what we found is that basically by putting those things together around these new programs, we can accelerate lots of programs bottoms up. And there's just not a lot of companies or stablecoin issuers that have been built in that way because it's been so expensive that it's just kept a lot of people out of the market, which creates a lot more stablecoins, a lot more ideas. I think on my way over here, there were 3 or 4 new ones launched while I was on my way over here. You know, it's just like it's a non-event now.
Right. And so what are you seeing, you know, in the long tail of companies who are launching the stablecoins? What are the use cases? Because obviously folks think about cross-border payments, there's the yield aspect. So now you've got neobanking and the list goes on. And so what are some of the use cases that people haven't necessarily thought of?
What we find really exciting is that we feel the market's draw in 4 different areas. The first is payments. Payments, people love these things because they lower costs, increase revenues. It's good business. It's not like very complex. Embedded finance, exactly the same. A great example of an embedded finance company would be like Rain. A great example of a payments company would be a company like CoinFlow. Everybody's leveraging custom stables in their workflow, but for different purposes, again, increasing new revenues and reducing costs. Ecosystems need stablecoins like Lightspark or Canton when they're emerging most, because that's how markets get built on the new ecosystems. Also, developers need them to build things like markets. Temple just launched a stablecoin on Canton, which is a great example of that, and financial institutions. What we're now seeing, especially with chains like Canton and privacy-preserving state, is that you can start to build things that look and smell like traditional core banking infrastructure, but running with the benefits of protocols. And then you can go back into a public blockchain whenever you want at basically no cost. So you get all the benefits, you get new revenues, and it applies unilaterally across all these regulated businesses in ways where the implementation time is like, how fast can you type or how fast can you prompt? The time to integration versus the last series of fintech is like, it's kind of a joke to try to compare them.
Yeah. And so now it's this easy new implementation layer. You mentioned the business models and additional revenue. Let's talk about the business models here. I think lots of folks are, knowledgeable about the business models of stablecoin issuers themselves in terms of yield and maybe on and off ramp fees. But what about the companies who are deploying them? So you talked about ecosystems and marketplaces and potentially neobanks and embedded finance. I think folks think of potential to earn yield, or maybe you pass some of that on to your customers, and that's maybe becomes a retention play or a additional kind of a customer attachment to make them more sticky. Then obviously with payments, you mentioned cheaper settlement and more efficient treasury. What are the other, maybe you can talk about those or some other ways that implementing stablecoins actually impacts the P&L of some of these companies?
Oh, yeah, absolutely. I mean, the biggest one we see for stablecoin payments companies is prefunding. So if you're working with like a traditional payment form like RTP, for example, you've got to put a bunch of capital at your financial institution partner. And as your payments volume grows, which they will grow if you're good, because there's so much demand in the market, they're going to grow. But your prefunding requirement goes up and up and up. So imagine that your business is really successful. You're doing like 100% month over month growth, and that continues for like a couple years. Well, now you need to like get $1 million or $5 million or $10 million or $20 million. Well, once you start getting into $50 or $100 million a day in volume, think about the cost on your balance sheet to pre-fund that. It's astronomical. Payments companies many times have to actually go raise capital in order to meet the pre-funding requirement. You put stablecoins in the middle and you lean on sort of like wholesale lines. Suddenly, you get access to short-term lines of credit in stablecoins in a way where you don't have to raise capital for that. There's enough margin when you're saying accepting a merchant payment like a coin flow to actually subsidize it in the flow. Those economics were just only reserved for really big companies like CRB or some other bank before. Now they're available to everybody who can figure out how to basically compose the payment transaction. And because we're willing to like say this is how you compose it, we think there's a lot of people that are building in that space that are never going to have to learn the TradFi solution, but get access to basically on-demand liquidity, that protects their balance sheet. That is a fundamentally different rate at which you can build a business. It helps them grow fast. There are also embedded finance applications where if you're using stablecoins, prefunding smart contracts behind card payments, that's very different than having to put capital into a pool that gets draws down on later when actual credit gets extended. It's a fundamentally more efficient business. So suddenly the more efficient mechanisms like stablecoins running on chain, like they're better business and they make money. And why would you not do this? It's like the easiest thing ever. And quite frankly, the infrastructure still has work to do for things like agentic commerce, but for everyday usage like merchant payouts and things like that, we're there. We have enough bandwidth in the chains. We can do it.
And so let's talk about the implication of what you just said. I think we talk about cost reduction in payments. We talk about more efficient treasury. And a lot of the things that we've just described, in particular with prefunding and reducing the capital required to grow a business, all come down to capital efficiency. And capital efficiency of running a business and the capital efficiency of growing a business. What that ultimately comes down to is the return on equity, or the return on how much money you need to grow a business. And so when you reduce the capital required to grow, you're making it easier for many companies to compete. You're making it easier for many companies to participate. And that leads to a shift in the market dynamics of a lot of the markets that we're discussing.
Yeah.
So it sounds like we're entering a world where it's either easier for existing incumbents, it's easier for startups, that increases competition. Where does the bottleneck then shift to?
I mean, I think the bottleneck shifts to actually individual companies and individual projects. If we're seeing so many companies start with, where do I start? What do I play with? How do I get started? It's like, not what book do I buy, but what library do I download to start getting moving? And I think that is like one of the attributes of companies that have great potential right now. One of the ones that is an attribute of companies that I think are in a dilapidated state are they're still trying to figure out, like, what do we do with stablecoins as a payments company? If you're a payments company who doesn't have like a stablecoin strategy, I find it hard to believe that when Visa has many different stablecoin strategies, if your payments company doesn't have a single one, that's a challenge. I think that is going to get sort of like pushed out of the market over a period of time. But the cool thing is most of the world's commerce is not on protocols yet. You know, we use these numbers like quadrillion and whatever else, but the numbers have the benefit of being true. Most of the commerce that's running through your phones is not running on chain yet. So the world that we're sort of like building into hasn't yet been realized, and most of the value that's get built in companies or protocols in the world doesn't yet exist. So like the risk is not playing the game, not what if you're wrong. So just like help as many people play the game as possible. Mm-hmm. That's kind of our view.
And when you add more people to the game, I feel like for the end consumer, hey, great, I've got more choices, more niche options and things that are more focused to me. But it sounds like more competition is going to reduce margins or reduce the overall pool of capital or revenue available to the market. So how should people who are already in the system, or maybe even startups who want to get into the system, be thinking about that?
It's an interesting mental model. People that are in payments often see basis points as their opportunity. In an internet environment, there is no basis point. The margin's already gone. So if you're operating based on what are the products and services you can basically build where the cost to move money is effectively already zero. We're below the 2 decimal threshold. Companies kill themselves to get access to a Fed bank account in order to get below the 2 decimal threshold on a cost basis per transaction. Blockchains are already there. We're like on decimal like 5, 6, 12, doesn't even matter. And so if the cost is already zero, how do you build a business where the value adds that you build on top of that opportunity are what people pay you for? Those should be higher margin. They should be stickier. And quite frankly, they probably are not as dependent on rent sinking as traditional payments have been.
Mm-hmm. Let's talk about that. Can we just like drill down into that a bit more? And so we're shifting from a world of, hey, only certain institutions had access to these rails in the first place. It's very expensive, regulatory, capital, and compliance. And therefore, hey, I've already spent the investment on these rails. Now I'm going to charge rent on them. We're now moving to a world where money movement itself becomes much more cheap. yes, there's still compliance, but that is improving with AI. And we're now having to move up the stack in terms of value creation and value capture. And so can you paint a picture of the future for us? As a financial institution or maybe a payments company or just a fintech in general, how should they be thinking about the future business models?
There are some future businesses that probably just don't exist yet, and we can't really imagine them until we're in the future. And then there are other things where my view is that if you look at the analog in banking, bank core systems have compliance baked in as a policy around the core system. The core system is a relational database that tracks state. And so a blockchain or a distributed set of validators is basically the same thing. A financial institution can apply policy to these different technologies in a way where the underlying cost is just dramatically different. And because the technologies are open and distributed by default, the numbers of vendors you have is probably much greater in the future, which drives down your vendor lock-in. With everything except for probably key management, which is probably a different topic entirely. But it's like, imagine a bank in a pre-internet era. And that's when ACH was designed. And we're talking about things that were designed when like modems were coming into like availability, not even like broad distribution. We're talking about availability. Suddenly, when we can build a financial institution or a financial infrastructure that's sort of like globally on by default with virtually infinite bandwidth that anybody can build on top of, including financial institutions, I do think it does and it has to fundamentally change the way that people build. Mm-hmm. Maybe not the way that financial services are regulated. We'll get new laws, but it's just better technology for the same services.
Mm-hmm. And so with that in mind, let's say, okay, the technology is much better. Policies are moving to a more programmable state. Obviously, AI is shifting everything to reduce the cost of building the software in the first place. I always think of the value being assigned to where there is actually risk-taking. And so my mind thinks about credit and other hard things where you need an institution or you need some firm or some software provider to do the hard work of underwriting and taking risk on behalf of folks, and therefore there's still margin there because that is not something that can be easily replicated by software. What other kind of examples or other areas of kind of value opportunity exist in a world where the rails themselves have made moving money very, very straightforward?
Yeah, I mean, if everybody has access to the protocols and the costs are basically zero, the opportunity ahead of us is what are the value-added services that can be built on top of that. And totally to your point, things like credit underwriting, credit extension, risk management, these are value-added products that a business puts its balance sheet at risk in order to offer. That balance sheet at risk function is a monetizable function and is something that should be monetized. I think that's very different than when you are effectively charging someone 2% for like letting a KMS do some like signing. These are just like functionally different things. This is played out, I think, at internet scale through companies like Cloudflare, which is really one of the companies that I think is pushing all of our thinking on agentic commerce. Because when you start thinking about this mental model where certainly like tens of thousands of TPS sounds insane, and so you start talking about 100 million TPS, where then we're not talking about a signing algorithm, we're talking about like what's the design of the silicon. These are different mental problems, but they're going to unlock an opportunity that's kind of like a what's next that we haven't been able to build into. Like, we don't know what's going to happen. We're just going to build stuff to create bandwidth to see what fills it. And I'm pretty sure the internet's going to fill it. It finds a way.
Mm-hmm. And so I want to take the opportunity to shift to something that we said earlier, and that is how banks will need to operate and how the future of fintech needs to operate as we shift towards this kind of on-chain world. I think what's happening, we mentioned it slightly earlier, but what's happening is we're seeing regulation actually change to facilitate some of these movements. Now, obviously, regulation is key when dealing in a regulated and compliant way. And we've had Genius so far. Clarity is in the works and has more momentum as recently as last week. There's been suggestions such as PACE, which is enabling fintech firms to have better access to federal rails for payments. And then on top of that, we're seeing a trend of more and more fintechs and stablecoin companies getting OCC trust chartered, getting federally regulated in order to have this ability to compliantly and in a regulated way be part of the U.S. financial system. So where is the writing on the wall? When I look at that, it seems as if banks are being unbundled, and the role of a bank and some of the core kind of jobs to be done that were almost exclusively done by banks are now being separated. So what does the future look like? Especially as someone who has been navigating around the banking and payment system, with Dwolla, in a previous life, what does the future look like when banks no longer hold the keys?
I think we have to imagine a future where they do and they don't. Like, two things can be true at the same time, depending on the client, depending on the market, depending on the use case. And I think one of my key learnings from building previous companies has been that if you take sort of the word or the comparison bias toward thinking in a verse, a left or right, and you start thinking about removing bias and considering what could work at different speeds and for what reasons, then we start to sort of imagine a world where infinite bandwidth against money is good for humanity. That will play out at every organization, across every device, across every financial institution globally, for every single person that's connected to the internet and every single device. So what do we need to do to help get us there? Our view is, for better or worse, stablecoins are for everyone. And this is the current model for how to get money into protocols, which we think of like that's our job, help protocols be successful, because increasing that GDP against protocols is like a mission worth contributing to. Like, it's bigger than just like stable coins, like digital dollars and stuff. Like, it has to be in order to spend your life on it. And so our view is that financial institutions play an important part about like how we enable humanity. You can't take away new technology from them and have financial markets work. So we should. And Genius accelerates that. And I think is like the ultimate permissioned thing that happened in the United States that took away a lot of people's fear and allowed them to take the fear and turn it into actual action to trying the new technologies, which is great. Imagine working in a financial institution when broadband was available and saying, we're not going to let you connect to the internet. That would suck. It would be terrible. And it'd reduce the customer experience, the products and services that you offer. And Genius was the thing that happened, at least in the United States, that gave financial institutions permission. And because US financial institutions do play an important part in the global economy, it did create pathways for different products to be built in the global economy too. And I think that's really exciting.
And so regulation is one piece of it, but I feel like there's still a lot of steps that needs to be taken for the market to get to this end state. And so I have a level of sympathy for the banking system and for various banks independently as well, because as you mentioned, the core that is essentially the database that they run on is just not currently up to date with where the market is going. And there's a certain amount of work that is needed to be done. And these aren't things that even though we have AI that is getting to places where they are being able to rewrite these cores over a weekend, it's still not that straightforward. And the banks won't necessarily. It's either especially a combination of risk appetite plus regulation and safety and protecting the existing customers' money means that they won't necessarily move as quickly. And depending on where that bank is, maybe it's only a percentage of their customers that are typically asking for this technology in the first place. And so they wait and they're waiting. And meanwhile, you have modern companies, modern fintechs who are building directly on chain, and then brand new de novo banks who are rewriting their cores from scratch. And so when I think about those two kind of forces, I feel like the banks who are in the middle are kind of squeezed. The largest banks have the technology and the teams to create this stuff. The startups that are building directly on chain are nimble, and the brand new banks don't have the legacy and the tech stack or the tech debt to deal with.
Yep.
So if you're the banks who are kind of in the middle, I feel like you're kind of stuck. What happens to these banks?
I don't know. I mean, it's a hard question because the solution isn't technology. The technology part is really quite simple. Use better technology, generate more money, you have a better business. This is not like complex. But people get in the way of that, particularly in financial institutions. And where you have financial institutions that are culturally getting in the way of utilizing the best technologies, they're going to have worse products, things that are not quite as good for their customers, and unfortunately probably will not gain market share because they're not doing things that are good to their business or doing good things that are good for their customer. And so there is going to be some percentage that are squeezed out. And I do think that's also one of the reasons why we're seeing so many pilots right now. If you work in and around the space, what I can say anecdotally is pilots used to be 3 to 5 years in order to get something into like a production environment with a 3 to 5 or even 7-year contract in a core system. Those pilots are now 3 to 5 weeks. It sounds like a long time if you're a startup person, but if you actually start to think about the compounding effect for thousands of financial institutions doing that simultaneously, it is astounding how fast the market is moving. I mean, you used to need to design like full sales teams to get access to a funnel big enough that hypothetically your VC money would get you to the other side of the funnel and you'd still be in business when it cash flowed. Now you can actually do that before raising capital, get customers as a part of a design pilot because you're competent, and start cash flowing with a revenue generating business before you ever raise any VC money. That changes the dynamic for why you would build with a protocol. And it starts with actually understanding what a protocol is and how it's going to be utilized at the financial institution. If you can speak the lingo, you have such an advantage. Just go use it. Just go build.
Yeah. And so, I think that's definitely some key takeaways for folks. And I always find it's often a coordination problem within an organization of, okay, I can see this thing coming. The technology is out there, but maybe you don't control the technology yourself. It's a vendor. You have to wait on your vendor's timeline before you can start to integrate. And then they say, okay, let's do a pilot with which customers. And it's only a certain percentage of your customers that are there, but you know that the next generation or a new segment is waiting for this new tech. So yeah, I also think it's a very kind of challenging place to be in, and there is going to be, a shift in the landscape over the next, call it 5 to 10 years. A combination of, the folks who are willing to kind of drill in now and learn and understand how they can essentially do this upgrade, and those who are kind of forced to by their existing customers. So, we'll see. I think one of the things that I'm always curious about, and many folks are trying, is stablecoins that are not backed by the US dollar, non-US dollar stablecoins. And I know, Brale, you've been a part of a couple, particularly a Mexican version. Tell us about how that journey has been, and what you've been surprised by about where adoption comes from for non-US dollar stablecoins.
I have the view that all money is going on protocols. Obviously, I'm a pretty big maxi in this way of like, that's just the way I'm pretty sure it's going to go. That's what I'm betting my career on. That's what I think is going to happen. And maybe there's going to be jurisdictions where the local powers that be don't allow it in the same way or force a different technology. But I generally think that's going to happen globally in every single form of value that we have within our lifetimes. And a whole bunch of forms of value that we didn't realize we needed or would want or would make use of. And if that is true, and again, our job is to sort of like help protocols realize their potential, we've started with US dollars because that's where our licenses are. That's where we have the strongest presence from a go-to-market perspective. But we're seeing demand come in from all over the world. We filed for licenses in other parts of the world outside of the United States, but realizing that demand is also predicated on building a go-to-market strategy that's actually aligned to that. Building non-USD backed stablecoins for us was a bit of an intellectual exercise to begin with. How would it work? What chains would it be on? How would the demand work? And it quickly moved into, well, if you don't have the language of that jurisdiction on your website, what's adoption going to look like inside of that jurisdiction? That's going to be low. And so we think there's lots of opportunities to partner globally on these things, and then partner with other companies that are building global clearinghouses between different FX markets that are really going to help grease the wheels to create comfort for not only US corporates that are doing business abroad, but companies that are domiciled outside of the United States when they're bringing capital in as a core initial use case that we think is going to be really important in FX markets.
Yeah, I think it's one of the areas within stablecoins that a lot of people are really excited about, because they share that same vision where you project 5 to 10 years, and it's hard to conceive of a world where most capital is not on-chain. And so if that's the destination, what are the steps required to make it happen? And I think, as you say, it goes down all the way down to distribution, even locally. You need to translate this into ways that people understand. It makes it very, very seamless and sometimes even invisible in the applications that they're using.
Absolutely.
And so we have a long way to go. I always think that, regulation in the US has only just started to kick off, and we still have many, many months, even a year or so of rulemaking to occur. And this same thing is happening in lots of different jurisdictions. And so where we are sitting in 2026, as exciting as it is right now, with 310 billion or so of supply, we have a long way to go. So that's it for this session. Ben, where can folks go to learn more about you and Brale?
You just Google my name. I'm a pretty easy guy to find.
Excellent. And for me, it's Chuk _XYZ on X and stablecoinblueprint.com. Thank you for this live session of Money Code.
Thanks so much for listening to Money Code. There was so much to take away from today's conversation. I learned a lot, and I hope you did too.
If you enjoyed this episode, do us a favor, share it with someone you know, or give us a 5-star rating on Apple, Spotify, or wherever you get your podcast from. Until next time.